Maxing out your credit cards might seem like a temporary solution, whether it's covering an emergency expense or just stretching your budget a little further. But what if I told you that this single decision could set off a financial domino effect that wrecks your credit score, traps you in debt, and costs you thousands in interest? It's not just bad, it's a financial disaster. Let's break down why. First, let's talk about credit utilization, one of the biggest factors in your credit score. Lenders don't just care if you pay your bill on time, they also look at how much of your available credit you're using. The rule of thumb? Keep it under 30%. But when you max out a card, that ratio shoots up to 100%, signaling to creditors that you're overextended. The result? Your credit score takes a hit, making future borrowing more expensive, or even impossible. And here's where things spiral. Say you're carrying a $5,000 balance on a card with a 22% interest rate. If you only make the minimum payments, you could be stuck paying it off for years. And by the time you're done, you'll have shelled out thousands more in interest alone. That's money you could have invested, saved, or used to build real financial security. But it doesn't stop there. Maxing out cards also means you have less available credit for actual emergencies. Imagine your car breaks down, a medical bill pops up, or you lose your job. If your cards are already maxed, you've got no safety net. That's how people fall into the cycle of payday loans, balance transfers, and high-interest personal loans, digging the hole even deeper. Let's take a real-world example. Mia, a 32-year-old marketing professional, had 2 credit cards with a total limit of $12,000. She maxed them out during a tough year, thinking she could pay them off once her income stabilized. But with the high interest rates and only being able to make minimum payments, her balance barely budged. Her credit score dropped, making refinancing impossible. It took her 5 years and nearly double the original balance to get out. So how do you avoid this trap? First, set a hard limit. Don't let your balance exceed 30% of your total credit limit. Second, prioritize paying down high-interest debt before anything else. And third, build an emergency fund before relying on credit. Even having just $1,000 in savings can keep you from reaching for the card when life happens. Remember, your credit should be a tool, not a trap. Use it wisely, and it can open financial doors. Use it recklessly, and it can lock you into years of struggle. What's your biggest challenge with credit cards? Drop a comment. I check out as many as I can. And if you found this helpful, you won't want to miss what's coming next. Click on the next video and take control of your financial future today.